Welcome back to the Deep Dive. We are tearing through the latest earnings calls and SEC filings, pulling out the crucial insights so you don't have to.
And today we have a really fascinating one, a case study in market dissonance, really.
We're talking about the Q2 fiscal 2026 earnings for Frequency Electronics, Inc., that's ticker FEI.
Right. And this was an after-hours call that just set the market on fire the next day.
It really did. The stock just exploded. We're talking a staggering 28.8% gain in a single session.
And the volume was just massive. It spiked to nearly 1.2 million shares.
Which is huge for them. Their average is what, under 300,000?
Yeah, around 293,000. So investors were buying this aggressively, which is, really unusual given what the headline numbers look like.
That's the core of it, right? The mystery we need to unpack. Because if you just glanced at the headlines, you'd expect a sell-off.
Or at least, a pretty muted reaction. The headline, JEP EPS, the earnings per share came in at 18 cents.
Just 18 cents. And the consensus was looking for what?
The street was looking for something between 30 and 34 cents. So, a pretty clear miss.
A nearly 30% pop on an EPS miss like that is, well, it's just insane. It tells you the market saw something else entirely.
Something structural and forward-looking that completely overshadowed any of that short-term pain on the profit line.
So what was the message from CEO Thomas McClellan? What did he sell them?
It was all about the revenue and the narrative.
Yeah.
Revenue was $17.13 million. That's an 8.3% increase year over year.
So a growth number, that helps.
It helps, but the strategic message was everything. Management basically convinced the market that Q2 was a necessary reacceleration.
A reacceleration after some of the program delays they saw in Q1, right?
Exactly. They argued that they've now established a new, higher baseline for revenue, and from that baseline, they expect powerful multi-year growth.
And the market just said, we believe you. That's what that stock surge means.
We believe your future. Yep.
Okay, so let's unpack this financial pivot. Because if the short-term profits are shaky, the conviction has to come from somewhere else. For a defense company, where do we start?
It has to be the backlog. That is the anchor point.
The definitive proof of future revenue.
Absolutely. And at the end of the quarter, their funded backlog hit a record high.
What was the number?
Around $82 million, which is up significantly from the $70 million they had just 6 months ago at the fiscal year end.
So that's the structural momentum investors were lashing on to.
Yes, and this leads right into maybe the most important takeaway from the entire call. Management guided that reaching a funded backlog of, and this is a quote, north of $100 million is plausible.
Plausible in the not-too-distant future. A lot of companies throw out big numbers, but FEIM, they added a really crucial layer of nuance here, didn't they?
They did. They clarified that the term funded backlog is, by its very nature, conservative.
So explain that for us. What does conservative mean in this context?
Well, think of it this way. When they get a huge multi-year contract award, let's say it's a $100 million deal, the initial piece of that gets funded and added to the official backlog might only be a fraction of the total.
Sometimes as low as 10%, right?
Exactly. So if they win a $20 million contract, they might only recognize the first $2 or $3 million immediately in that funded number.
And the rest just sits in the pipeline, unfunded, waiting for the government to allocate the next tranche of money.
Precisely.
Yeah.
So the full potential that's already embedded in their existing contracts is way, way larger than that $82 million headline number suggests. That $100 million goal isn't just a wish.
It's based on converting stuff they already have.
Right. It's based on existing large contract opportunities converting into those funded tranches.
Okay, but we have to address the big blemish here, the profitability. While they were banking all this future work, the margins in Q2 really, really suffered.
They certainly did. Gross margin fell by about 1,000 basis points year over year.
Just to clarify for you, that's a 10 percentage point drop.
Right. A huge drop from 48.2% last year down to 38.2%. And operating income followed, falling from $2.6 million to $1.7, a serious shift.
So if the backlog is at a record and revenue volume is up, why did profitability tank so hard? What causes a drop like that?
Well, according to management, and the market clearly agreed with them, it was not a sign of mismanagement. It was a mix shift issue.
A mix shift, meaning the type of work they were doing changed.
Dramatically. They moved away from their high-margin satellite payload work. I mean, that dropped from 59% of revenue all the way down to just 27% this quarter.
Wow. And they pivoted toward what?
Towards massive engineering-intensive DoD and non-space programs. That stuff accounted for 69% of their revenue.
Ah, so that's the non-recurring engineering, or NRE, we hear about. Lots of upfront design work.
Exactly right. NRE is basically paying the engineers to do all the custom design and qualification before you can start stamping out the product.
It's like a custom kitchen remodel versus selling thousands of identical IKEA cabinets.
That's a great analogy. The custom job has huge upfront costs and lower initial margins. But once that design is locked, the repeatable production phase, your IKEA cabinet phase, that's where the high margins finally kick in.
So the margin drop was really the cost of securing that record backlog.
It's the investment in future high-margin production runs. And the path to recovery is seeing those programs transition toward that repeatable production.
What did the CFO say about the timeline for that?
He noted that while a full return to those, prior year levels might take a bit longer, directionally, they expect margins to be flat to slightly up in the coming quarters. The pain should be moderating.
And the company is structured for this, right? They're debt-free, which has to be a huge comfort when you're in a big operational ramp-up.
Oh, that strong balance sheet is critical. It's a huge stabilizing factor. They've got a $31 million working capital position, a current ratio of 2.6 to 1.
All the liquidity they need.
All the liquidity they need to absorb these temporary NRE costs and go after these huge contracts without needing expensive financing. They have the muscle to execute.
Let's shift to the strategic view then. That Q2 revenue of $17.1 million, it wasn't just a bounce back. It was the third highest revenue quarter they've had in a decade.
Yeah, that really backs up management's point about having a strong and growing core business.
And what about that revenue that got pushed out earlier in the year? Some of that was due to customer requirement issues, not just the government shutdown stuff.
Right. And management confirmed those issues are now largely resolved. A big chunk of that delayed revenue is already back in the pipeline.
And more is expected next quarter.
Exactly. And it's important to remember the shutdown mostly affected new contracts. So if those administrative delays hadn't happened, their funded backlog would probably be even higher right now.
Okay, this brings us to the really exciting stuff, the additive growth lanes.
This is the white space. The opportunities that convinced the market this stock was worth 30% more overnight. We're talking quantum sensing, ALT-PNT.
Alternative positioning, navigation, and timing.
Right. And magnetometers, new satellite constellations, all of it.
Let's drill down on the biggest catalyst here, which sounds like it's straight out of science fiction. The Colorado Quantum Hub.
It is absolutely cutting edge. They're building it out in Boulder, Colorado. They've hired several senior scientists away from NIST, the National Institute of Standards and Technology.
The best of the best in this field.
Truly. Their focus is on high-sensitivity applications, magnetometer development, Rydberg sensors.
Which are these incredibly precise sensors, right? They can detect tiny shifts in electromagnetic fields.
Minuscule shifts.
Yeah.
And they're leveraging CRADA's cooperative research and development arrangements with research groups at NIST to accelerate all this.
So what's the immediate financial takeaway? And an investment like this is usually a cash drain at first.
And this was the most fascinating financial detail from the whole call. Management expects the Colorado operation to be a positive profit contributor in Q3.
Already, in the third quarter.
Modest, they said, but positive. They're already contributing to externally funded R&D programs. They're converting this high-tech investment into revenue almost immediately. That's a critical data point to watch.
And on the product front, we have Turbo. What's the potential there?
They're reiterated a near-term sales potential of a few $million. And they call the $20 million opportunity for next year very, very realistic.
That gives investors a really tangible near-term metric to track.
It does. And they added important context. Their products are too precise and, frankly, too expensive for things like the $1,000 kamikaze drones.
So they're not playing in the low-cost disposable market?
No. Their focus is on sophisticated military and high-end commercial applications that need extreme reliability and precision timing. They play in the higher value part of that ecosystem.
Now let's tie this back to the big defense programs. They mentioned the Golden Dome initiative.
Right, the U.S. Missile Defense Framework. They expect strong participation there across several aspects. They're already involved in ground-based systems like Patriot and SARTs.
And they see a path to getting into the space-based missile defense parts of Golden Dome over time.
Exactly. And connecting that to the bigger picture, Their tech is already on the U.S. Space Force's Navigation Technology Satellite 3, the NTF-3.
Which underscores their role in creating resilient PNT architectures, making sure our GPS and weapons timing can't be easily jammed or spoofed, a huge growth area.
And when asked about political risk, management basically said their growth is independent of who is in the White House.
How so?
They see two independent drivers. First, the global commercial space market is just growing on its own. And second, the current geopolitical environment means robust defense spending is a bipartisan priority. Defense modernization is not going away.
That makes the whole growth narrative feel very sturdy. So let's put it all together. The market decided the short-term EPS miss and the margin hit were just transient costs.
Yeah, necessary NRE costs to secure a much larger, much longer-term book of business.
And that's all validated by the record backlog and the clear path to growth in these new areas like quantum.
Absolutely. The decision was to prioritize future revenue stability over today's profitability. So for you, the listener, what are the key catalysts we need to monitor?
First, and this is the most important one, we need to see evidence of that margin recovery. We need to see that transition from custom NRE work to repeatable high-margin production.
Second, we're watching for turbo booking announcements that line up with that few million-dollar near-term marker.
Third, we need to see those significant backlog step-ups now that the administrative delays from the government are reversing.
And finally, any big specific contract wins. Something tied to Golden Dome or a large satellite architecture. Those are the big ones.
And one last thing, they don't think they need a ton of new capital to do all this, right?
Correct. They're in a cautious hiring mode, but they believe their current facilities can handle the growth without significant new CapEx. Great news for cash flow.
Okay, this is our mandatory, this is not financial advice segment. We're about to pitch an outrageous but plausible trade idea based on our analysis.
And remember, we're only providing analysis, not personalized investment advice. You have to do your own due diligence, always.
So the setup here is all about momentum and execution, isn't it?
It is. FEIM's one-year return is almost 178%. It's crushing the aerospace and defense ETF, which is up about 33%. The market has already confirmed its belief in this story.
So we're looking for a highly leveraged way to bet on them converting this narrative into actual funded contracts and doing it quickly. What's the trade structure?
And the idea is to structure an aggressive long position. You do this by buying out of the money call options.
How far out of the money are we talking?
Targeting a $50 strike price, or maybe even higher. And for expiration, you're looking out to Q1 or Q2 of fiscal year 2027.
So that's a bet that the stock accelerates way past where analysts think it will be in the next year, year and a half.
Exactly. The thesis is that this trade hedges you against any near-term margin choppiness, but it leverages you to a potential surprise catalyst.
And what's that surprise?
It's a combined force of a few things happening at once. The Colorado Quantum Hub becoming profitable in Q3, management actually hitting that $100 million backlog vision, and a major contract announcement hitting the wire.
Maybe a big new tranche of Golden Dome funding or a massive turbo order?
Right. If those catalysts align, the stock could easily run into the $50 to $60 range much, much faster than anyone expects. That would make this highly leveraged bet pay off massively.
It's a high-risk, high-reward bet on management's ability to execute perfectly over the next year. Outrageous maybe, but definitely plausible given the setup. Okay, so to recap this deep dive on Frequency Electronics, this is a highly technical defense company that's clearly transitioning from a mixed financial report to a strong multi-year growth runway.
The market looked right past that short-term earnings miss. It validated the new baseline narrative from management, and it bid the stock up almost 29%.
And that confidence is all underpinned by that record high $82 million funded backlog and these new high potential markets like quantum sensing and next-gen PNT solutions.
So as you move forward and evaluate this story for yourself, here's a final provocative thought to consider. Given how conservative that funded backlog number is, what percentage of the implied total contract value do you think the company has already locked up in its pipeline?
And which specific upcoming award, a quantum tech breakthrough, or a major slice of missile defense funding do you think will be the single largest contributor that drives that next big step up toward their $100 million vision?
The success of this entire turnaround story now depends completely on the details of contract conversion.